Yeah, let's take a look at round 3P, or the practice round 3. Do a little recap here. I've come down with a nasty cold, so if my throat clearing and coughing and whatnot are a little more than usual, please forgive me. And if I have to pause occasionally to sneeze or something, again, I ask your forgiveness. Yeah, we again start at the top and we take a look at some things. While ROS is at the top, return on sales, that's usually not one that I focus on too much. Get return on sales, it can be a big deal, and especially here where you are comparing apples to apples. I mean, at first glance, you can take a look at this and say, this looks good or this looks bad, for each individual team, no doubt. But when it comes down to it as an investor, and I'm kind of looking at, I guess, this game as an investor, then I ultimately look at ROE and earnings per share as bigger factors. Now, in the banking world, we spend a lot of time just looking at ROA. And you could do that, though, and you always had an understanding, I guess, that ROA's impact on ROE was pretty uniform across banking, and that's because banks typically have about the same amount of equity. It's more of a regulatory thing than anything. So, yeah, I digress. Anyhow, I'm just trying to emphasize that it's okay to look at this. At first glance, you can see that Baldwin obviously had some difficulties here. Erie, some difficulties, but a little less so. But Ferris, Digby, Andrews, Chester, all positive, and so if you got positive numbers, you know that they made a profit, right? So at first glance, you can say that. Asset turnover can be interesting. Digby did a nice job of turning over its assets, so I would assume from that then that it would probably narrow the gap a little bit on ROE, okay, because it's using its assets a little more efficiently than Chester and far more efficiently than some of these others, okay? And asset turnover is simply total sales divided by assets, right? And so how it's a good efficiency measure for a company like this. Okay, leverage. Okay, I get kind of concerned when leverage gets above 2.25. Now, this is one of those items that you can be discounted for. Okay, I am not against leverage. In fact, using leverage is a powerful tool to build a company and move forward, but it involves risk. Okay, and so the reason I discount when you get above a certain percent or a certain number is the number's 2.25 is because you're taking on a risk that is from a banking standpoint. Yeah, it's not an arbitrary number, but it's a number that I chose. From a banking standpoint, I just think that that's getting a little bit too far ahead of yourself. Now, from a owner's perspective, if I were owning a company like this in the early rounds, to exceed 2.25 wouldn't bother me in the least. Okay, would not bother me in the least. I would gladly take on that kind of leverage in order to plan ahead for some of the things that are coming. Okay. And part of the reason for that is if you go back and look at your situation analysis, you got a pretty good idea what's going to happen throughout the rounds. You're in a fast-growing industry, and its its growth is practically guaranteed throughout the 8 rounds. And so, if I knew that I was going to be competing in that type of an industry, a little bit of leverage wouldn't bother me. So, I'm kind of digressing a little bit again. We got some emergency loans. Erie's is small. Okay, they won't even get a discount for that because I set again kind of an arbitrary limit at $5 million. Baldwin's huge. Okay, and one of your questions is going to be what contributed to that. Maybe I'll take a look at Erie when we look at the cash flow and show you what contributed to their emergency loan. Why don't I worry about small emergency loans? I do, but there again, I've seen too many times where a team gets hugely penalized for having a small emergency loan, even though they kicked butt otherwise. And as a banker, you know what, if I got a team, if I got a company that's doing extremely well, making lots of money, making right decisions, and they screw up a little bit kind of on their checking account, yeah, you know, I'll lend them I'll make them an emergency loan. Good profit for the bank, and I got a company that's kicking butt. Now, it's not necessarily true in Erie's case because they showed a pretty big loss, you know, as did Baldwin. But there are other companies. Chester, again, I know I said this probably at the beginning, but it doesn't surprise me, and it won't surprise me that through the practice rounds, Chester will probably dominate. But when we get into the competitive rounds, you know, Chester won't change its behavior and it won't change its decisions. I'm hoping that by the time we get to the competitive rounds, that you guys, student-run teams, will definitely change the way you approach the game and the way you play it. And usually by the end of the competitive rounds, the computer team is not victorious. Okay, I remember at least once when the computer team was almost bankrupt because the student teams had learned so well that they competed very aggressively and just kind of buried the computer team in that case. Cumulative profit I don't worry too much about. And the reason for that is in our world, and fortunately or unfortunately, it's kind of what have you done for me lately is what I'm interested in. These numbers are interesting. You know, these are big. SG&A to sales, huge, with the exception of Chester, which is kind of surprising. You know, they still generated by far the most sales, even though they have by far the smallest percentage of SG&A to sales. That could be two things. You know, one, they may be spending amounts that are similar, right? But they're doing it far more efficiently, and they're generating a lot more sales. And, you know, I'll give you an example. I mean, their sales are $267 million versus Andrew's $113 million. And if you look at the percentages here, well, it looks to me like they've probably spent about the same amount of money. Okay, and when we get down to the income statement, we can take a look at that. They've spent similar amount of money, give or take a couple million. Okay, but Chester's generating that many more sales because this is, you know, a ratio to sales. So Chester's doing it more efficiently. One of the reasons might be if you look at the contribution margin, their contribution margin is quite a bit smaller. Okay, so they may be generating sales. Maybe they're doing it through lower pricing. Okay, that's one possibility. I don't know as I look. On the other hand, Digby, look at them, 19.3. So they're spending a lot of money, okay, to generate some sales. Okay, and they're doing pretty well. They had the second best sales, still $100 million behind Chester, but they've got a really big contribution margin. Okay, which tells me that maybe they're keeping their prices a little bit more towards the top end of the scale. And the same could be said here of Ferris. Okay, a smaller amount of SG&A to sales, but look at that huge contribution margin. So again, I'm guessing that they might be keeping their pricing towards the top end. So we come down and the stock market summary. Still got, you know, other than Andrews, every team has sold some stock. Looks like Baldwin's kind of backed away from that maybe. Digby maybe backed away from that a little bit. And I don't know this round. We'll see when we get to the cash flow. But it's interesting. Again, I'm going to repeat, selling stock, you know, like especially Erie and Ferris have done, have a very adverse effect on your earnings per share. Okay, that's number one. Number two, let me repeat something that you've probably heard me say in prior classes. Debt is always cheaper than equity. When you sell stock, you're using equity in order to finance growth, whatever the case may be. Not always a bad decision, don't get me wrong, and especially early in the game it might be okay, but it's a very expensive decision. Debt is always more expensive than equity. I'm sorry, equity is always more expensive than debt. Okay, it's one of those numbers. It's you know, kind of like I forget where I was going, but it's kind of like some of those other numbers that it's hard to really pencil that out. It's like the overtime number. Yeah, sometimes it's kind of hard to pencil out why it's more expensive, okay? But it is, okay? It's very costly, and in direct cases, it's costly because it really has an adverse effect on earnings per share and ROE, okay? Let me just their shares throughout, okay? Now this past several rounds are what, 40% higher than what you started. Okay, so just to give you an idea, Digby's ROE then, if you increased it by 40%, would actually exceed Chester's if Digby had not sold any stock from the very beginning. Okay, might have created some problems. You know, they might have some cash problems and those types of things, but you know, those could have been offset maybe by borrowing. Might have created some leverage issues, but that's still, it's cheaper than equity. So, here we go. Let's take a look at the cash flow. And again, I said let's look at Erie, because Erie did end up with an emergency loan of $3,915,000. Well, what caused that? First thing, they did have to pay off their current debt from last round. Okay, and they didn't make a decision to borrow any themselves. They did issue some common stock, minuscule. Okay, $480,000 common stock. Isn't really that meaningful, and it actually creates an expense to when you issue stock. You pay 5%, I believe, fee to issue stock. But Erie had a loss. Okay, so when I look at what contributed to the emergency loan, it's loss. Okay, it's accounts payable, it's inventory, and it's accounts receivable. Okay, offsetting that a little bit was depreciation, which is a kind of a non-cash expense, but also plant improvements then was a negative, okay, paying off its current debt. So the negatives they show up as negatives. Imagine that. Okay, the positive in this case was the depreciation, where we're just kind of adding back a non-cash expense from the income statement, and the net then is the $3 million. So a lot of things contributed to Erie's emergency loan, right? Loss, accounts payable, inventory, accounts receivable. Okay. So when we have an inventory, this is one of those things you got to think about too a little bit. You got to think through. So if we have inventory and we show a negative in the cash flow, that means that our inventory increased was the problem, right? And so it took extra cash to fund that inventory increase. Okay. That's the same with our accounts receivable. So our accounts receivable increased. That could be a good thing. That probably meant our sales increased some, right? But it did have an adverse effect on cash. And then plant improvements. Look at that, plant improvements, man. Chester, man, they don't know that we're coming close to the end of the practice rounds. It's his computer team maybe, but you see Andrews making some huge investments, and Ferris still making some huge investments. And if I'm not mistaken, Ferris has made some reasonable investments all along, as has Erie. Erie's investments have been new products primarily. Okay. So as we scroll down a little bit here, cash. Look at Chester's got lots of cash. I can pick on the computer team here. You know, it issued some stock or sold some stock, and it borrowed money. So between the two of those, it's about $20 million, and it's got $52 million. So, you know, as critical as I sometimes am of the student teams, that's really poor cash management for Chester. Why borrow $14 million and sell stock, as those both have expenses associated with them when you've got that kind of cash on hand? Okay, did have current borrowing, and I don't have any problems with that. If you're a little bit concerned about a shortfall, that's where you ought to finance it. Okay, and it could be that they're trying to match up. They did $45 million in plant improvements. It could be that they're just kind of trying to match up some of their debt with the improvements and whatnot that they're making. It's okay, but yeah, not when you got that much cash on hand. Okay, do something with the cash. Cash is, I know they say cash is king, but cash can be a huge downfall in this game. Okay, simply put, here, $52 million in cash, which you don't need, right? And so its equity is $114 million. If you got rid of that cash, let's say you paid out a $50 million dividend, Chester's equity would drop to $65 million then, right? its ROE would nearly double. Okay, so I would as an investor, if they paid out that dividend, I'd get a bunch of money from the company, right? And the company's ROE would substantially increase, and so those things are positives. Okay? Now, again, that might create some other issues. That might be a little more than what you'd want to do, because your leverage would go up and different things like that. But anyhow, that just shows you the power of good financial and cash management. Those things are so important. Accounts receivable, again, just a function of sales. That's why theirs is so big. Baldwin had a lot of inventory on hand. Other teams, not so much. Digby, some. And yet Digby did pretty well, but still a decent amount, probably more than they'd like in inventory. Some of these small ones makes me concerned that there's some stockouts, which is always troubling. Total assets, of course, Chester, with their sales, necessarily they got to be a little bit bigger. And they are as well in total equity. They're making more money, but again, their total equity could have been reduced substantially by paying a dividend. Right? That's a question that I'll be asking in the future. If Chester paid a $30 million dividend, what would its ROE have been under those circumstances, or if it bought back stock or whatever. Okay. Our income statement, we come down. TQM is going to start next time. Okay. I believe it starts here in round 4. TQM is an expense. Okay, TQM is an interesting investment. Total quality management is what TQM starts for, and it's an expense. But it's an expense that. Why do I say it's an expense? And it's an expense because it gets written off all in that same year. Whereas if you're buying equipment, capacity, or automation, it gets written off over time. And so when you're buying when you're buying capacity or automation, the impact in the near term is very little. Okay, with TQM, the impact in the near term is great, but it really improves performance over the long term. So you got to weigh that a bit. But if you're playing for the long stretch, investments in TQM, remember that while you expense them that 1 year and it has a negative impact, it has a huge impact that accumulates basically over the remaining time frame. And it's huge. When you're making those decisions, it gives you some ideas of what it's going to do the next round, but those impacts continue on for each round thereafter. So pay a lot of attention to that TQM. Taxes. Okay, I better roll along. I'm going to get a little long-winded here with my cold. That's kind of crazy. Still, way too much capacity. Okay, only really team Chester, Digby to a smaller extent. Chester used almost full capacity first and second shift. That's going to be one of your questions too on the assignment. Okay. And Chester clearly won. Okay, we'll see that when we do the winter spreadsheet. But it's just a reminder. Yeah, are they going to show up that their labor costs were probably a little bit higher because they used that second shift and paid some overtime? Yeah, but that is more than offset by the efficiency that they get in using a plant, to its full capacity by using that second shift. Okay, you guys aren't getting those efficiencies. The students are not even coming close to getting those efficiencies. Team Erie, Team Ferris, way more capacity even in the first shift than what they're using. Okay, Digby just barely extending out a little bit. So, again, that's one of those that's a little more difficult to quantify. I'd probably have to spend an hour to sit down myself and pencil that out, and then to explain it might even be more difficult. But some interesting things going on here. Andrew's not much inventory. Look at that. I kind of glanced down. I'm saying, boy, there's a lot of zeros here. So there were some stock outs. Okay, quite a few stock outs. So we're going to see some real disparities, I think, between actual and potential sales. But then you have a bold here, which sold 0 units and has 969 units in inventory. Well, what happened there? Well, Bold, if you look over here at the performance and size, probably would have been in the performance category, okay, performance segment. That's where it originally started and probably still is. But let's take a look at the guide. MTBF. Demand scores fall rapidly for products with MTBFs beneath the segment's guidelines. You guys can read through this, but at 5,000 hours below the range, demand for the product falls to 0. Okay, and this is the performance, or should have been the performance category, and so MTBF's one of the more important features. And I think the range there is 20 to 25,000, and so if we're at 15,000, it's 5,000 below the low end, and so the demand was 0. That's why Bold sold 0, okay, and was left with all kinds of inventory. If you look at bid in the high end, I think you'll see that it was getting close, and again, you go back and read in the guide. Okay? So a simple mistake there, it looks like that Team Baldwin made in adjusting those MTBFs. Why do you do that? Well, you do save some material costs. Your material costs are substantially lower when you do that because you're using inferior components and whatnot. But you guys wouldn't want to buy a $1,000 iPhone if it had inferior components, if you knew or if you thought or expected that it might malfunction in a relatively short period of time. And that's what you're dealing with there. And so I don't know if that's a fat finger mistake or if that was intentional there, but certainly caused all kinds of problems there for Baldwin in the high and the performance categories. Cruise down. Look at it in the low end. Cedar sold, 3,800 units, or 3.8 million actually. Far and away better than the other teams, and we'll see why when we get down there. I'll cruise down and look at these statistics. So the traditional segment, kind of interesting. Usually we see a pretty big clump of folks right here in the middle. And we really don't have that. We're seeing a lot of them here, and it could be that people are using similar strategies that, product life cycle strategy that's allowing these to drift. That's very possible, but it's certainly creating opportunities for those that are in the middle, which are Cake and Days, okay, and Baker. It's Cake and Baker. Okay, Days sold quite a bit, even though it's about falling out, which is kind of interesting. But that's probably its age. Okay, its age is very close, and age is important, right? Ideal age. Okay, age as of December 31st, 1.78. So again, if you're never going to be right on the age, and if you're right on at the end of the year, it probably means that you got too far ahead during the year. Okay, so they're always moving. The demand, we look at this as static, and it's not. The demand's always moving or always changing. And so when you're looking at 1.78 and Cake 1.6, you can probably assume that that's about as good as it gets, that they were ahead of the age profile, younger than, okay, when it was revised. You can go look at the revision date in August. Okay, it became younger then, but then as the year went on, it passed right through the exact. Let me see, I don't have that right, because it was younger then, and so it stayed younger then, actually. Go back up, because it would have revised then, and it would have gotten younger than 2, and then it just kept getting older as it went on. So, actually, these ones should have been a little bit better, but at the end of the year, you'd think you'd want to be at about 2.2, 2.3, somewheres in that neighborhood. Maybe would have been more perfect, down here. Of course, Bead is really selling in a different category because it's in the low end, basically, has moved to. But, that's interesting, I guess. So, what are the second ones? So you got price, and then you got ideal. And those are fairly important. They're fairly well matched up is the positioning. And so that's a case where Cake and Baker are positioned well. Okay. Day's not positioned quite as well, but spent, look at that. Oh, no wonder Day sold well. Sorry, I should have caught that earlier. Spent nearly $6 million, so twice what Baker spent and nearly 3 times what Cake spent. Okay, but this gets back to efficiency, right? So Cake spent way less, okay, 1/3, and yet still sold more. And that gets back to customer buying criteria, having the age, but then what's next on the list? Price. So its price was quite a bit better than Days. So Days is spending a lot on that, able to sell it for quite a bit more. Okay, that's interesting with the pencil. So they made $3 more per unit, and they sold 1.8 million units, or almost 1.9. So that's $5.5 million extra, and they spent 6.9 million. So, might pay, right? That advertising in that case might pay if in fact, that's the sole factor that drove that. You could also argue that if Days had been a little better positioned, okay, it would have sold more as well. So, yeah, getting long-winded. My mind's wandering a little too much with the cold, I think, going on. In the low-end statistics, Chester kind of dominated. Again, here, age. Look at that. Age is the second leading factor. Price is the first. So let's take a look. Their price is also the best, right? At least tied for the best. And then their age. So they got the top two, okay, covered there. And so that's important, obviously. I mean, they sold twice as many as any other product there. But again, that's because they've got the customer buying, boom, just nailed it, right? And ideal position, not so important. MTBF, not so important. So they've let their MTBF slide, as has Acre. Both teams ran out. Okay. Andrews could have sold a little bit more, so could have Chester, right? Andrews' problem here is their age. Okay, they've done some revisions to this product. Not really. Where is their Acre? I can't see it on this one. It almost looks like, they've, I think that's Able up there. So yeah, we'll have to take a look. But it almost looks like they made a decision to move their product backward. Okay, and yeah, they did. They moved it backward. Okay, which hurts in two ways. You're spending money on R&D, but you're also still, when you're moving it backward, you're making the age younger. Okay, on a product where age, you want an older product. Okay, so that was a double bad whammy there for Andrews doing that. Sorry to pick on Andrews. High end, here, look at this. You've really got Chester dominating here. Digby was allowed to make a lot of money just kind of because they're hanging around. Okay. You guys gave Digby the round, and I'll bet you if I sat and put a pencil to it, it would be, they sold 28% more here in the high end than what they should have. Andrews is the team that gave that up. Didn't make enough because Andrews is pretty well positioned there, right? Digby's a little bit further back in terms of their product. So Andrews lost out and gave it to Digby. Dixie sold just about as much as Sid. Right, definitely sold out. Okay, Andrews Adam product could have sold a lot more because it's well positioned. It was priced okay, priced less than Dixie. MTBF might be outside the. Yeah, that would be a little bit painful because they're using an MTBF that's towards the bottom. You guys need to read the guide when it talks about MTBFs and those things and saving money, and then understanding the customer buying criteria, that those things can be important. Here it's the third on the list, but it's still 19%, so it is important. Okay. It's a huge turnaround there. Okay, and Dixie did spend a lot in the high end as well. Okay, promoting their product, had a higher price, got good margins because of that. The performance where Bold would have been and probably would have done okay. Again, they sold none. Here, Andrews, Digby got the benefit. Erie, Ferris especially gave up quite a bit here in the performance. Size, a little more even in terms of actual versus potential. And there's the numbers. You ought to take a closer look at the perceptual map. Again, it's kind of interesting, and you see the computer teams, gotten out front, and impossible almost at this point for the other teams, the student-run teams, to do catching up. Andrews is staying kind of close, at least in these two categories, but not so much up here. Okay, that's one of those cases, and you guys have figured that out, and you'll figure it out even more as you get into the competitive rounds. But to stay competitive in terms of your positioning and stay right up here towards the front and right on the cutting edge in these high ends is really important. But to do that, you have to start early. Okay, you have to start early and not get because you can't get your revision date out past 1 year. If you do that, it's not going to revise, and it's a very painful experience. So you got to start early, and if you don't, you fall behind. Okay, and we see that kind of happening. Again, the traditional segment, this has got me kind of baffled a little bit, because usually it's really, really kind of competitive here in the middle, but we see a lot of teams, there's products are drifting back into the low end, which might make the low end really competitive, and maybe the traditional end not so much. So HR saw some pretty good investments there this time. Look at Digby's improved their performance by about 7%. Baldwin, a little lesser extent, but 3%. Now, if you go back and Digby could look at their own annual statement and know exactly how much money they spent on their labor costs, but I'm kind of roughing it. If you look at their variable costs, I think they were a little over $100 million, so not quite 50-50, but they probably spent about $50 million on labor costs. Well, they're getting a 7% productivity boost, so they're saving about $3.5 million. Sure, they spent a lot of money here, $2.5 million there, I think, if that's right, and plus the training hours and whatnot would have some other costs associated with it. But okay, this benefit, this 7%, will continue on. Okay, this is a sunk cost; it's gone now. Okay, but that benefit, that 7%. So while they'll save $3.5 million maybe the initial year, next year if they produce more and do more because they have to, because the industry is growing, they might save $4 million. Right, year after that they might save $5 million. Okay, based on this year's investment without any future investment. Okay, they might continue to invest and get this productivity index up even higher. Okay. Those things are huge, the long-term payoffs on those. Here's the TQM summary, and we'll take a look at that next week, because that will be a part of your guys' decision making for round 4P, if I'm not mistaken. So the winner, let's take a look. Let me expand that. Okay. And scroll on down. I don't think it's too much in doubt. Team Digby, okay, from the student teams was successful, 91.5 points, no deductions. Okay, Chester would have won for the overall. The computer team, 96.5. Won in both earnings per share and ROE, whereas Digby was a close second. Contribution margin, though, Digby did a little bit of making up. Look at Team Ferris making a push over here. Again, Team Ferris probably would have done a little better on earnings per share, maybe, and ROE. Score-wise, I don't know. I don't know if they could have, with the stock thing, if they could have caught up to Digby, but maybe. Yeah, maybe if they hadn't sold all that stock and created that much additional equity plus that much additional shares outstanding. So Team Digby wins, and they're exempt from doing the homework next round. So congratulations to Team Digby. I'm plenty long-winded, so I'm going to sign off.